Another firm Australian inflation report has reinforced expectations that the RBA may need to tighten policy again, potentially as soon as March. Yet, despite the increasingly hawkish policy backdrop, AUD/USD continues to struggle to push meaningfully higher. So, the question is, what's holding the Aussie dollar back? To understand that, it helps to step back from the inflation noise and focus on what's driving AUD/USD behavior. These next three charts help to frame the underlying dynamics. All use the exact same framework. On the left, AUD in black overlaid against a key macro driver, shown in red. On the right, the rolling correlations across multiple time horizons, 20, 60, 120, and 240 days. Let's start with short-dated yield differentials. This chart pairs AUD/USD against Australia-US 2-year yield spreads. The broader relationship remains strong, particularly over longer time horizons. But the key shift lately is momentum. Yes, spreads remain elevated, but they're not widening with the same speed as earlier in the rally. And when that impulse fades, so too does one of the Aussie's most reliable tailwinds. Let's now shift to China's influence through the FX channel via USD/CNH. Here we're looking at AUD/USD overlaid against the Yuan, with the scale of the latter inverted. Again, the longer-term relationship remains very clear. But the story here is also very similar. The Yuan has already strengthened considerably against the US dollar, just like the Aussie. That's been a supportive factor, but it's no longer providing the same incremental impulse as before. And finally, let's look at risk appetite through an Asian-centric cyclical lens. This chart captures AUD/USD against Nikkei 225 futures. No surprises in the relationship itself, given the Aussie's reputation as a risk proxy. But once again, momentum is doing much of the work. The Nikkei has pushed higher, then stalled after hitting record highs. That removes another source of upside pressure for the Aussie. Combined together, the picture is very straightforward. Yield spreads are no longer widening rapidly. The Yuan has already done plenty of heavy lifting. Risk sentiment has stopped improving, albeit remains at elevated levels. When key drivers stall at the same time, AUD/USD doesn't require a negative catalyst to struggle. It simply runs out of fuel for upside. And this is where the technical picture slots in nicely. On the weekly chart, AUD/USD has pushed into a fairly heavy resistance zone. We're now testing levels that previously acted as major turning points, including the highs from early 2023. Momentum has clearly improved, but it's also becoming very stretched. RSI 14 is sitting at elevated levels, reflecting the strength of the recent move. MACD also remains supportive, but the speed of the rally alone argues for a period of consolidation. Put simply, the chart is no longer screaming breakout. It's suggesting hesitation. When you combine that what we've already discussed, the price action starts to make a lot of sense. The rally itself hasn't faltered, but at these levels, with these drivers, a pause is hardly surprising.